Have you ever looked at a giant company's huge profit number and thought, is that really the whole story? Well, today we're going to crack open that mystery. We're diving into Ind AS 108. That's Indian Accounting Standard 108, which is basically a key that lets you see exactly which parts of a business are actually firing on all cylinders and which ones might just be coasting.
Right, so picture one of those massive conglomerates, you know? They're into everything, tech, hotels, maybe even paper. When you just see that one single profit number at the end of the report, it's kind of like looking at a locked treasure chest. You know there's something valuable inside, but you have no clue which parts are sparkling diamonds and which are, well, just rocks.
Exactly. So how do you, or any investor or analyst for that matter, figure out what's really driving the business? This is precisely the problem Ind AS 108 was designed to solve. It's the tool we use to get that chest open. So here's our game plan. First, we'll talk about why that single bottom line isn't enough. Then we'll see how this standard lets us see things the way management does. After that, we'll define what a segment actually is, figure out how companies pick which ones to report on, and finally, look at all the good stuff they have to tell us. All right, let's jump in. First up, getting past that single number. A big company's annual report can honestly feel a bit like a black box, right? You see the final output, the total profit, but all the interesting stuff happening inside, the individual wins and losses of each division, is totally hidden from view.
And here's why that matters. A really impressive total profit could be coming from just one superstar division, while another part of the company is actually losing a ton of money. Without that breakdown, you'd never know. You can't really see the risks, and you can't spot the real engines of growth.
And this leads us to the really clever part of IS 108. It's called the management approach. What this means is the standard basically forces companies to show us, the public, their business segments in the exact same way their own top bosses look at the business. It's almost like getting a peek at the internal reports that land on the CEO's desk. Now, the key to this whole approach is a person, or sometimes a group, called the Chief Operating Decision Maker, or CODM for short. This is whoever in the company is actually making the big calls, deciding where the money goes and judging how each part of the business is performing. Now, here's the thing you've got to remember. CODM isn't a job title. It's a function. It might be the CEO or the chief operating officer, or it could even be the whole board of directors. The standard doesn't care about their title. It cares about who is actually reviewing performance and making those key strategic decisions. So, if the CODM is the one doing all the reviewing, what exactly are they looking at? Well, that brings us to the basic building blocks of the whole report, the operating segments themselves. For something to officially be an operating segment, it has to pass a simple three-point check. First, it has to be a part of the business that's actually out there earning revenue and spending money. Second, its performance has to be regularly reviewed by that CODM we just talked about. And third, you need to be able to get separate financial info for it. If it checks all three of those boxes, boom, it's an operating segment. Okay, theory's great, but let's make this real. Let's invent a company, say ABC Tech. It's a big tech firm, and it's got a few different divisions. A software unit, a hardware products group, a financing arm, and a couple of different services businesses. Each one of these could potentially be an operating segment, as long as they pass our three-part test. Okay, so a company like our ABC Tech might have a whole bunch of these internal operating segments. The next step then is to figure out which ones are important enough that they absolutely have to be shared with the public. This is how we get from that long internal list to the final report you see. Which, of course, leads to the big question. Do they have to tell us about every single one? And the answer is no, thankfully. Ind AS 108 has some really clear quantitative tests to help filter them down, making sure that we only focus on the segments that are truly significant. All right, let's get our hands dirty with some numbers. Here's some data for 5 potential segments. Now, a segment becomes reportable if it meets any one of 3 tests, all based on a 10% threshold. We're going to look at its revenue, its profit or loss, and its assets. Let's go through them one by one. First up is the revenue test. Super simple. The total revenue of all our segments is $1,500, so our 10% threshold is $150. As you can see right here on the chart, segments A, B, C, and D all clear that bar easily. So they all pass test number 1. Next, we've got the profit or loss test. Now this one's a little bit trickier, so pay attention. We add up all the profits from the profitable segments. That's 85. Then we add up all the losses from the losing segments. That's 30. We take the bigger of those two numbers, which is 85. Our threshold is 10% of that, so 8.5. Looking at the absolute numbers, segments A, B, and C all pass this test. And finally, the asset test. This one's easy again. Total assets are 6,000, so our 10% line is at 600. And just like with revenue, segments A, B, C, and D all have assets above that mark. So remember the rule, a segment just has to pass one of these tests. In our example, A, B, C, and D are all definitely in the running to be reported. But wait, there's one more check, a final safety net, if you will. Once you've figured out all your reportable segments using those 10% tests, you have to add up all the revenue from external customers. That number must be at least 75% of the company's total external revenue. If it's not, you have to keep adding more segments, even the smaller ones, until you hit that 75% mark. It just makes sure the report is actually comprehensive.
So, what's the big picture here? Well, for investors, the upsides are huge, right? You get a much better sense of the company's risks, you can make smarter judgments, and it helps you forecast future sales. But on the flip side, companies have some real concerns. They worry about giving away too much information to their competitors. And honestly, figuring out how to allocate costs between different segments can be a massive headache.
Okay, so the company has done the work and identified its reportable segments. For our last section, let's talk about the final payoff. What information do you, as someone reading the financial statements, actually get to see?
So what's in that final report for you? It's basically a treasure trove of data. You get to see exactly how the company defines its segments, the profit or loss and asset numbers for each one, and this part is absolutely crucial, a reconciliation that shows how all those little pieces add up to the company's big totals. Plus, you get breakdowns by products, by different countries or regions, and even details about major customers.
And this last point is incredibly powerful. Seriously, if a company gets more than 10% of its total revenue from one single customer, it has to tell you that. Now, they don't have to name the customer, but just knowing that that dependency exists, that gives you a massive insight into that company's potential risks. So, you see, Ind AS 108 isn't just some boring accounting rule. It's really a window into a company's soul. It lets you see the business the same way management does, the good parts, the bad parts, and the parts with the most promise. So the next time you open up an annual report, you'll know exactly where to look to find the real story. The only question is, what are you going to look for first?